The evolution of money, from gold to fiat and the global economic shift. Welcome to this in-depth exploration of the origins of money, the evolution of global financial systems, and the monumental shift from gold-backed currency to fiat money. This journey will uncover how these transformations have shaped modern economic policies, financial markets, and the global economy. We will also examine the implications of these changes, the role of central banks, and the future of money in an increasingly digital and interconnected world. The birth of money, from barter to precious metals. In the earliest civilizations, transactions were conducted through barter systems, direct exchanges of goods and services without a standardized medium of exchange. While functional in small, localized economies, barter systems were inherently inefficient. The lack of a common measure of value made trade cumbersome, as determining equivalent worth between disparate goods, such as livestock, grain, or tools, was often subjective and impractical. To overcome these limitations, societies turned to precious metals, particularly gold and silver, as universal stores of value. These metals were durable, divisible, portable, and scarce, making them ideal for facilitating trade and preserving wealth. By the 6th century BCE, the Kingdom of Lydia, modern-day Turkey, minted the first standardized gold coins, revolutionizing commerce and laying the foundation for monetary systems that would endure for millennia. Gold and silver became the backbone of global trade, enabling economies to flourish. However, as trade expanded and economies grew more complex, the limitations of physical metal as a medium of exchange became apparent. The emergence of paper money, a practical innovation. The logistical challenges of transporting and securing large quantities of gold and silver spurred the development of paper money. The Tang dynasty in China, 7th century CE, pioneered the first form of paper currency, government-issued IOUs, backed by reserves of precious metals and goods. This innovation spread to Europe, where central banks began issuing banknotes redeemable for gold. The gold standard, which emerged in the 19th century, formalized this system. Under this framework, currencies were directly tied to gold reserves, ensuring stability and trust in financial transactions. For example, the British pound sterling became the world's dominant reserve currency, backed by the vast gold reserves of the British Empire. However, the gold standard had its limitations. As global trade expanded, maintaining sufficient gold reserves to back every issued banknote became increasingly untenable. The rigidity of the gold standard also constrained governments' ability to respond to economic crises, as money supply could not be easily adjusted to meet changing economic conditions. The end of the gold standard, a global economic turning point. The gold standard's limitations came to a head in the 20th century. The economic upheavals of World War I and the Great Depression strained global gold reserves, forcing many countries to abandon the gold standard temporarily. In 1944, the Bretton Woods Agreement established a new international monetary system, pegging global currencies to the US dollar, which was in turn backed by gold. However, by the 1960s, the US faced mounting pressure as foreign governments began redeeming dollars for gold, depleting US reserves. In 1971, President Richard Nixon made the historic decision to sever the dollars linked to gold, effectively ending the gold standard and ushering in the era of fiat money. Fiat currency derives its value not from physical commodities but from government decree and public trust. This shift granted central banks unprecedented flexibility to manage money supply and interest rates, enabling them to respond to economic challenges with greater agility. However, it also introduced new risks, including inflation and the potential for mismanagement. The role of the Federal Reserve, power and controversy. The U.S. Federal Reserve, established in 1913, plays a pivotal role in the global financial system. As the central bank of the world's largest economy, the Fed wields immense influence over monetary policy, interest rates, and money supply. Its dual mandate, to maintain price stability and maximize employment, has made it a key player in shaping economic outcomes. The Fed's structure is unique. It is a quasi-public institution with private member banks, operating independently of direct political control. This independence is designed to insulate monetary policy from short-term political pressures, but it has also sparked controversy. Critics argue that the Fed's actions disproportionately benefit financial elites, exacerbate wealth inequality, and create moral hazard by bailing out failing institutions. During financial crises, the Fed has acted as a lender of last resort, injecting liquidity into markets to stabilize the economy. For example, during the 2008 financial crisis, the Fed slashed interest rates to near zero and launched quantitative easing (QE) programs, purchasing trillions of dollars in government and mortgage-backed securities. Similarly, in response to the COVID-19 pandemic, the Fed expanded its balance sheet to over $9 trillion, flooding markets with liquidity to avert economic collapse. While these measures have been credited with preventing deeper recessions, they have also fueled concerns about long-term consequences, including asset bubbles, inflation, and the erosion of the dollar's purchasing power. The consequences of fiat money and inflation. The transition to fiat money has fundamentally altered the global economic landscape. By decoupling currency from physical commodities, central banks gain the ability to expand money supply at will. While this flexibility has enabled governments to stimulate economic growth and manage crises, it has also led to persistent inflation. Inflation, often described as a hidden tax, erodes the purchasing power of money over time. While moderate inflation is considered a sign of a healthy economy, excessive money printing can lead to hyperinflation, as seen in historical examples like Weimar Germany and more recently in Venezuela. The COVID-19 pandemic highlighted the inflationary risks of fiat money. In response to the economic fallout, central banks worldwide implemented unprecedented stimulus measures. The US Federal Reserve alone printed trillions of dollars, increasing the total money supply by approximately 40% within 2 years. This rapid expansion contributed to record high inflation, with consumer prices in the US rising at their fastest pace in 4 decades. The inflationary environment has had far-reaching consequences, including rising costs of living, shrinking savings, and widening wealth inequality. As the value of fiat currencies declines, investors have sought refuge in alternative assets, driving up prices in real estate, stocks, and cryptocurrencies. Stock markets, cryptocurrencies, and the future of money. The rise of fiat money has reshaped investment landscapes. With traditional currencies losing value over time, investors have turned to stock markets and cryptocurrencies as alternative stores of value. Stock markets, once seen as reflections of economic productivity, have increasingly decoupled from underlying economic realities. Despite economic downturns and rising unemployment, markets have surged, driven largely by excess liquidity and speculative trading. Cryptocurrencies, led by Bitcoin, have emerged as digital alternatives to gold. Built on decentralized blockchain technology, cryptocurrencies offer transparency, security, and protection against inflation. Bitcoin, often referred to as digital gold, has gained traction as a hedge against fiat currency devaluation. However, its volatility, regulatory uncertainties, and environmental concerns pose challenges to its widespread adoption as a mainstream currency. Meanwhile, central banks are exploring the development of central bank digital currencies, CBDCs. These digital versions of fiat money aim to combine the benefits of cryptocurrencies with the stability of government-backed currencies. While CBDCs could enhance payment efficiency and financial inclusion, they also raise concerns about privacy, surveillance, and the concentration of power in the hands of central authorities. The global impact of US monetary policy. The US dollar's status as the world's reserve currency amplifies the global impact of Federal Reserve policies. Approximately 60% of global foreign exchange reserves are held in dollars, and the majority of international trade is conducted in dollars. As a result, changes in US interest rates and money supply reverberate across the global economy. For example, when the Fed raises interest rates to combat inflation, emerging markets often face capital outflows and currency depreciation, as investors flock to higher-yielding US assets. Conversely, when the Fed injects liquidity into markets, it can fuel asset bubbles and speculative investments worldwide. The dominance of the dollar has also enabled the US to wield significant geopolitical influence. However, this reliance on the dollar has prompted some countries to explore alternatives. China, for instance, has been promoting the use of its currency, the yuan, in international trade and has developed the Cross-Border Interbank Payment System, CIPS, as an alternative to the SWIFT network. Conclusion: what lies ahead? The global financial system is at a crossroads. The era of fiat money has brought unprecedented economic flexibility but also significant risks, including inflation, wealth inequality, and financial instability. As trust in fiat currencies wavers, alternative systems, whether digital currencies, decentralized finance, or a return to commodity-backed assets, are gaining traction. The rise of cryptocurrencies and CBDCs suggests that the future of money may be increasingly digital. However, the transition to a new monetary paradigm will not be without challenges. Regulatory frameworks, technological infrastructure, and public trust will play critical roles in shaping the next chapter of monetary evolution. As we navigate this complex landscape, one thing is clear: the global monetary system is undergoing a profound transformation. Whether fiat money will continue to dominate or give way to a new era of digital and decentralized finance remains to be seen. What is certain is that understanding these shifts is essential for policymakers, investors, and individuals alike as we prepare for the future of money. So, what do you think? Let's share your opinion.